All right, shares of Upstart are crashing today, down more than 25%. The market's only been open for about an hour. It is not looking good. The company just reported its third quarter. What in the world is going on? The stock is still up for the year, but it's way down from the peak. I'm Jason Hall. This is The Smattering. I'm going to give you an update on Upstart's third quarter results, what's going on, everything you need to know right now. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/the smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check out that link after this video. All right, start. Look at today's stock price. This is brutal. It's down almost 26% already today in early trading. From the beginning of the year, though, the stock's still up 65%. If you bought close to the beginning of the year, probably feeling okay. If you bought over the summer, man, that's brutal. This is a stock that has been super volatile since it went public back in very late 2020. Stock surged up. It was like a 12 bagger at the peak. It's now about 26% below its debut price in its first day of trading. So it has definitely been a volatile stock. A lot of investors trying to figure out if Upstart's going to be the future of lending or not. So before I get into the earnings, if you're not super familiar with Upstart, here is a brief summary of what the business is. This is an AI-based lending platform. They're increasingly owning more of the debt, but the company's goal is to not be the lender, to be the platform for other lenders to use. And they have over 100 lending partners that have signed up to use the platform or are using it to some more or less degree, depending on which lender we're talking about. So the goal is to use their proprietary AI that they have developed to be a more accurate assessor of risk, right? So versus the existing FICO model, that's the credit regime that everybody uses for the most part to make the bulk of their credit determinations with a little bit of in-house stuff mixed in with it. What Upstart says is that our AI uses a lot more data points and is more accurate. We can do two things. We can help you increase the volume of lending that you're doing by offering lower APRs, attracting more potential borrowers, or having better quality underwriting, still being more at kind of the market level pricing for your interest rates, get a little bit better return. And so far, the early data looks pretty good. According to what they're giving us, it does look like their models do work pretty well. There's some challenges with the business right now based on the macroeconomic environment. Surging interest rates, continued concerns about inflation, putting pressure on the consumer, has lenders concerned and pulling back from the lending that is at the core of what Upstart does, which for the most part has been unsecured debt, personal loans. That part of the business has been pretty weak. That's why the stock has come down so much, because lenders have pulled back from that. They've also been aggressively expanding in auto lending over a year at this point. And they've signed deals with a lot of OEMs. And recently, they announced that this quarter, they've signed deals with a couple of the largest subprime auto lenders in the US. So we see lots of progress on getting partnerships. We don't see much progress on revenue. Okay, let's dive into the quarter here. The bottom line, wasn't a great quarter, but we didn't expect it to be a great quarter. We knew revenue was going to be down. We knew the losses were still going to be there, but we were expecting to see maybe a little bit better results. But again, just under $135 million in revenue, operating loss, about $44 million. That did improve. Again, it was a $58 million operating loss year over year. So that got better. That was expected that it would get better. That's been their trajectory. They reduced a lot of headcount over the past year. They've reduced other operating costs. So we knew that was going to get better. In parallel with the operating loss getting better, the net loss also shrank year over year, even on that smaller revenue base. And again, adjusted EBITDA, you got to be careful with adjusted EBITDA because you're taking your earnings and then you're taking out interest, taxes, depreciation, and amortization. And then you're adjusting some other stuff there too, like stock-based compensation and other expenses they're adjusting out. But again, they're saying that they generated $2.3 million in positive adjusted EBITDA in the corner. That's good, but you got to understand they're adjusting, they're taking adjustments, and there's real material things in there that you need to understand they're adjusting for. This is important. Right in the middle here, contribution margin. We're seeing that improve substantially, up 64% versus 54% year over year. Seeing it continue to improve, that's really good, right? Now, I'm sure you're looking at this and you're wondering, okay, you're saying this was all more or less expected. Why is the stock down so much? You know what? You told us you were going to do $140 million In revenue, you did about 135. So you missed on revenue. You told us you were going to do 65% contribution margin. You told us your net loss was going to be about $30. You told us you were going to generate $5 million in positive adjusted EBITDA. Management, you missed your guidance. Again, this is not just Wall Street analysts' guidance. This is what management said the company was going to do. Their outlook for the quarter, you missed it. Okay, you missed it. Now we're going to look forward. The fourth quarter is not going to get any better. Revenue about 135 million. Contribution margin is actually going to worsen. It got better. Now it's going to worsen again. It'll be better than it was a year ago, but it's starting to deteriorate from where it was in the quarter you just reported. You're saying your net loss is going to expand, and that adjusted EBITDA gain that you just reported, you're going to be back to break even on an adjusted EBITDA basis. So what you're telling us is that the numbers that you just gave us, you're saying they're basically going to hold tight on revenue and everything else is going to be a little bit worse after you miss guidance. So the market's saying, looking forward, business is not going to get any better. And we also don't exactly trust your guidance. You've missed it in the past. So I think that's why the stock's down. I think that's the short version of why the stock is down so much because, well, the results were okay, but they missed estimates. They missed their own guidance, and they're guiding for worse results in the fourth quarter. The market's always looking ahead. Now, here's the thing. If you're buying a stock, your chances of making money are far better if you're thinking long-term, if you're thinking like a business owner. If you're not thinking like a trader, there are lots of people that are traders full-time and they make good money because it's what they do full-time. But for most of us, individual investors, your best secret to success is to be an owner. Find great companies that can be disruptive, companies that can grow their cash flows over time, own them, diversified portfolio for a long period of time, and that's how you're more likely to make money. How does Upstart fit in that? Upstart is still losing money, right? When you have a business that's losing money, you need to think about how, number one, start with thinking to the downside. What if things continue to deteriorate? Does the company have the resources to continue to survive as it builds to scale? In an Upstart's case, as the cycle, this down cycle for consumer lending, it's putting a lot of pressure on consumers and a lot of lenders are pulling back because of concerns about risk to their own balance sheets. Is Upstart built to get through that period? Let's take a look at the balance sheet. So again, you get this comparison to the beginning of the year versus where it ended the quarter. Get a little bit more cash on the books, a little bit of a reduction in loans that it holds. Again, its end goal is not to be the owner of loans, but it does hold some loans. That amount has grown sequentially. Again, we look at where it ended in the second quarter, the end of June, about $838 million in loans, and now it's 972 months. That amount's gone up. So at the same time, it's got a little more borrowings, a little more debt on the books now than it did at the end of the prior quarter. But I think it's manageable amounts. You think about the amount of cash that it has. I think it's going to be fine in terms of getting through this environment. Is Upstart worth owning at this point? If you think about the upside, as an investor looking forward, think about the upside, massive market. The core business today, it's really personal loans and increasingly auto. It's a pretty big business. We're talking like $900 billion in annual opportunity. Home equity line of credits, starting to get into that home market. It's certainly not a big market right now because of the real estate environment, the supply of homes and interest rates having shot up. Nobody's refinancing right now. Eventually, maybe small business, but again, it's a massive market. And even if it just takes an increasingly small portion of any of its core ones today, there's a tremendous amount of upside if the product continues to deliver. So far, the data is good. The data is supportive that Upstart has a great product. We're going to find out more when we eventually, inevitably go through a recession, whether that's in the next few quarters or the next few years. Nobody knows the answer. Inevitably, a recession is going to happen. Some people are going to struggle. They're going to have to make the hard decision about which bills are they going to be able to pay and which ones are going to default. And then we'll find out about the quality of Upstart's origination and its AI product for lending. So you take the progress that we've seen with the business, and yes, there's been all of the volatility with revenue, management missing guidance a little bit, forward guidance for not necessarily really good results in the next quarter. It's not surprising. It's not a great environment for lenders. So none of these things should be surprising, and I don't think they undermine the greater thesis for Upstart. So again, you take that massive opportunity, look at the progress that we have seen, all of the partners that have signed up that seem primed to go forward with Upstart. You look at the market value of the business at less than $2 billion market cap at recent prices, and you have to think there is some real opportunity here for investors. But you have to be willing to take further losses because if they don't execute well, quality of the loans don't hold up. If other competing products perform just as well, And this just becomes a commoditized product and not really something with some real durable advantages. Future profits that a lot of us were expecting may not come. If you're willing to take on that risk because of the massive multi-trillion-dollar opportunity for a company that's worth less than $2 billion today, I think Upstart does look like an attractive buy.